Hello viewers. You know why cigarette stocks find favor with investors despite being sin stocks? Well, that's because cigarette is addictive and investors expect growth despite all the adverse regulations the industry attracts. Well, if you're looking for such businesses without having to take exposure to sin stocks, you have coffee with its delightful aroma and caffeine kick that its consumers can't do without. In today's video, I'll talk about one such business, CCL Products, that claims to be the world's largest instant coffee exporter and private label manufacturer. 95% of CCL's finished products are sold as white label to global coffee brands and retailers for their private labels. So, this is a B2B business, unlike Nestle that sells instant coffee under its own brand directly to consumers. Here, CCL makes the products while its client prices and markets under its own brand. The final seller could sell it at a price 20 to 100% higher than what they buy from CCL. Now, this model allows CCL's clients to focus on branding and retailing while outsourcing manufacturing and quality control to CCL. The global instant coffee market volume is estimated at 9 lakh metric ton, of which 50% is served by brand owners with captive capacity and the rest by B2B players like CCL Products. As such, CCL's addressable market is at 4 to 4.5 lakh metric ton with 7 to 8% market share. Now, 88% of CCL's business comes from export markets. Top 5 clients typically comprise 26% of its total revenue. 60% of the business comes from existing clients and the rest from new. Its products include freeze-dried coffee, spray-dried coffee, and agglomerated coffee along with specialty coffee. Now, freeze-dried coffee is processed at low temperatures that allow the coffee to retain its aroma and flavors. It is an expensive and time-consuming process as compared to spray-dried process. As such, the margins in freeze-dried are higher by 10 to 15% as compared to spray-dried. Now, CCL's total production capacity is 55,000 tons. 25,000 of this is based in Andhra Pradesh, India, and 30,000 tons is based in Vietnam. The company has a trading and a value addition unit in Switzerland that offers better access to European clients with supermarkets and with no additional taxes. Now, here is what makes the company a differentiated player in what could have been a B2B commoditized player. Being one of the largest, the company enjoys economies of scale. With strong R&D and tech processes, the company is able to undertake capex at low cost. It makes some of the equipments in-house. With tech-based processes, it can also manufacture high-quality coffee with low grades of green coffee, thus getting a relatively better yield. And it is able to meet customers' demands for customization with an offering of 900 blends. Both its plants at Andhra Pradesh and Vietnam are strategically located to coffee plantations and enjoy low-cost labor advantage. Vietnam is the second largest in coffee plantation after Brazil and offers tax advantage as well. Vietnam also allows easy access to East Asian markets. Within India, South India accounts for 70% of coffee consumption. A diversified sourcing mix and client base offer lower regional concentration risk. The company does not own coffee plantations, which offers higher fixed asset turn ratio as compared to Tata Coffee that has its own plantations. With over more than 2.5 decades of experience, the company has established not just a strong customer base, but also a strong sourcing network from across the countries. It works on cost plus basis. As such, raw material prices are hedged through back-to-back sale contracts and they protect the company from inventory risk. There is also a natural hedge for currency fluctuation as raw material is procured in dollars and exports comprise 88% of the revenue. Now, all this is evident in the company's margins that have not gone below 20% in last 10 years. The company has been doing value addition. It has a packaging facility of 12,500 tons with 60% utilization with scalability up to 25,000 tons for small packs. Small packs allow the company to target beyond the bulk business and offer 10 to 15% higher margins. It is also enhancing product portfolio to specialty and flavored coffees that have less competition and better margins. These could be 5 to 10% of the portfolio but contribute to 10 to 15% in value terms. The growth triggers in the business include revenue from capacity increase at Vietnam from incremental capacity at Vietnam from 13,500 metric ton to 30,000 metric ton. The utilization at enhanced capacity is expected at 50% in FY24. The company further plans to add and commercialize spray-dried capacity of 16,000 tons in India by first quarter of FY25. It will also be commercializing 5,500 tons of freeze-dried capacity at Vietnam. These expansions will be funded by debt and internal accruals. The peak debt is expected at rupees 12 billion, which will keep debt to equity ratio well below 1 time. Now let me share CCL's big bet. That is the company's extension from B2B to business to consumer, that is B2C, and its ongoing evolution to be a branded FMCG player. Through its subsidiary, the company is expanding domestic business. The domestic business comprises 12% of the revenue at rupees 2.5 billion. Of this, 64% is from its own brands under Continental range, thus making the shift from B2B to B2C business. It is now ranked third in domestic instant coffee market worth rupees 25 billion with market share of around 5%. The company has achieved break-even in India business, but this is more of an incubation phase where the company wishes to reinvest all its profits and expand off now than focus on cash generation. The domestic instant coffee market is expected to grow at a faster rate than the global market. The company is also targeting institutional clients like Reliance, corporate, coffee chains, startups, and consumers through smaller packs and is focusing on increasing the touchpoints within India. It is also getting into adjacencies such as high potential food categories like plant based meat, which is expected to grow 10 times. Coming to financial indicators, the return on capital and equity stand at 16% and 20% respectively versus an average ROE of 19% over 5 years. The 5-year operating profit margin is at 22% and the dividend payout is at 25%. The director's remuneration was 7.6% of net profit, which is within the prescribed ceiling in FY22. The promoter's stake in the company is at 46.3% and up from 45.9% in the last 3 years. The management has guided for a volume and EBITDA growth of 18 to 20% in the coming years and over a 20% EBITDA margin target. The company faces competition from Nestle, Tata Coffee, and Olam Group, amongst others. Overall, CCL Products expects global market share to increase from 7 to 8% to 10%. The stock is trading at a price to earnings or PE ratio of 30 times as against a 3-year median PE of 27 times and 5-year median of 22 times. With huge growth potential in the business, the company indeed deserves to be on your watch list. And with focus on B2C extension in the very long term, it could be an FMCG brand to reckon with. Let me know if you agree with me. Now, before I end, please note that today's discussion does not imply any buy or sell or hold view on the stock. This is for knowledge purpose only. If you found the content useful, do like the video. In any case, I would appreciate your feedback and comments. For more such updates, subscribe to Equity Master YouTube channel. Thank you for watching. Goodbye.